Chapter 5 Accounting Ratios and Analysis 1. Introduction. The financial statements analysis assists to understand the information disclosed in the financial statements of the business entity easily. Due to this simplicity, different stakeholders find it very convenient to make their investment decision. Ratio analysis is included as another tool of financial analysis. Ratio analysis is a traditional and widely used tool. Definition and explanation. I. M. Pandey says that the relationship between two accounting figures expressed mathematically is known as financial ratio. Ratios help to summarize the large quantities of financial data and to make quantitative judgment about firm's financial performance. Financial statements shows accounting statistics, gross profit, net profit, sales, equity share capital, equity shareholders funds, current liabilities, current assets, etc. are included as a component of financial statements. Accounting analysis is done between two relevant components based on a specific relation. As discussed earlier, the gross profit and sales are two relevant components. There is a relation between these two from the viewpoint of accounting. Assume sales are Rs 3 lakh and gross profit is Rs 90,000. Here, Rs 90,000 shows accounting information. This figure does not explain the interpretation of any analysis. If this information is to be presented in the form of ratio, it can be presented as follows. Gross profit in percentage is equal to gross profit divided by sales into 100. So, gross profit ratio is equal to 90,000 divided by 3 lakh into 100 is equal to 30%. This analysis shows that for every sale of Rs 100, gross profit is Rs 30. Due to the ratios, accounting figures can be presented in usable form. 2. Peculiarity of ratios. In ratio analysis, comparison is done for useful interpretation of financial statements. An individual ratio does not indicate any favorable or adverse situation. It is to be compared with a standard ratio. For example, above stated gross profit ratio 30% does not indicate any favorable or adverse situation. It represents result only. Thus, when ratios are compared with any standards, then the utility of it is proved. These standards can be as under. By comparing the standards, the information of good and bad results can be obtained. 1. The comparison with ratios calculated based on past financial statements. 2. The comparison with ratios developed by the business entity. 3. The comparison with ratios of industry. 4. The comparison with ratios of competitors. Gross profit ratio is revenue ratio. Assume that it was 25% in the previous year and 30% during the current year. It shows that there is a growth in the condition of gross profit of the business. If the ratio of the previous year is 40%, it means the gross profit condition is reported adverse in the current year. 3. The objectives of ratio analysis. The objectives of ratio explains its significance. Due to ratio analysis, the information of financial statements can easily be understood briefly and scientifically. Ratio analysis is useful to different users of financial statements to make their decisions. Their objectives or significance is as follows. 1. For financial statement analysis, only accounting statistics information is available from details disclosed in financial statements. These figures do not represent any analysis. Ratio analysis works as indicator to the users of financial statements. Different stakeholders undertake analysis of profit and loss statement and balance sheet. To make this analysis meaningful and useful, ratio analysis is used. 2. For simple presentation of accounting information, ratio analysis represent accounting figures in more simple, in brief and in scientific form. The components of financial statements have specific relation with each other and the ratio analysis clarifies the meaning of this relation. For example, debit equity ratio. This ratio shows the proportion of equity against debt. Many components depend on the other component. Example, net profit ratio. Here, the creation of profit is from sales. This ratio shows the proportion of net profit to sales. Ratio analysis represents the relation between two related components and their simple understanding to the users. 3. To know profitability status of the entity. The basic objectives of a business is to earn profit. In accounting, the profitability of the business can be measured by applying the ratio analysis in different forms, where gross profit ratio, net profit ratio, return on capital employed, rate of return on equity share capital, etc. are included here. 4. To know liquidity status of the entity. The liquidity ratio explains the capacity to meet short-term liabilities of the entity. From the liquidity, short-term solvency of the business can be measured, where current ratio, liquid ratio, etc. are included. 5. To know long-term solvency of the entity. The long-term solvency of a business entity is measured by deducting total liabilities from total assets. Higher the positive differences, higher the solvency. This is the ideal measurement for the entity to obtain borrowings. The lenders of the business entity focus on solvency. The analytical presentation in this context is availed by ratio analysis, where debt-equity ratio, total asset-debt ratio, etc. are included. 6. To know operating efficiency of business entity. Different types of assets are acquired by the business entity. For measurement of effective and efficient use of assets, ratio analysis is useful. For this, turnover ratios are used. Example, stock turnover ratio. 7. For forecasting. The trend of respective item can be seen by ratio analysis. Example, during last 5 years, the gross profit rate is 20%, 23%, 24%, 26% and 29% respectively. Here it is observed that there is a growth in the gross profit ratio during the last 5 years. This indicates favorable trend for a company. This trend can be useful to the company to undertake planning and forecast. 8. The information about weak aspect. There may be overall good result of the business entity. Out of different aspects like profitability, liquidity, solvency or efficiency, there may be weak performance of any one aspect and good performance of any other aspects. Thus, the average result will be satisfactory. But under ratio analysis, each aspect is evaluated individually. So the information for weak aspects can be obtained and necessary remedies can be undertaken. 9. For interfirm and intrafirm comparison. The comparison of the operating performance of a business entity with the other business entities is known as interfirm comparison. This ratio analysis assists to know how and to what extent a business entity is strong or weak as compared to other business entity. This can be obtained by ratio analysis. When the comparison among different divisions of a business entity is done, it is known as intra-firm comparison. This ratio analysis is useful to know which division is strong and which one is weak as compared to the other division of the business entity. Ratio analysis is used for different objectives. The uses of ratio analysis explain its significance. 4. Limitations of ratio analysis. Ratio analysis is a traditional tool for measurement of different aspects of a business. Through it, the strengths and weakness of business entity are measured. This tool has limitations also. They are discussed as under 1. Dependent on results of financial statements. Under ratio analysis, the evaluation of different aspects is done on the basis of information of financial statements. The success of this analysis is based on information disclosed in the financial statements. If true and fair information is not disclosed by the financial statements, the analysis would also present incorrect picture. 2. Absence of standard ratios. Any individual ratio does not provide any analysis or interpretation. The use of ratio can be established only when the standard ratios are available for comparison. If standard ratios are not determined, the computed ratios become useless. Thus, the absence of standard ratio shows uselessness of ratio analysis. 3. Influence of price changes. The base of ratio analysis is financial statements. Financial statements are prepared with historical information. In historical information, the effect of inflation is not considered. Thus, price changes are not considered in ratio analysis also. This is also a limitation. 4. Avoidance of qualitative factors. Ratio analysis is a method of quantitative analysis. Ratio analysis is purely based on quantitative information, but the qualitative aspects for measurement of operating results like honesty, loyalty, tempo, which are strongly associated with employees or officials or management, are ignored. These factors also have influence on the operation of the business entity. 5. Difficulty in comparison. When two business entities follow different accounting policies, the information obtained by ratio analysis becomes useless. Example, the use of different methods like depreciation or stock valuation by two business entities. In these circumstances, the use of ratio analysis does not become useful. 5. Presentation of ratios. The presentation of ratios can be done in different ways. These forms are as follows. 1. In terms of proportion. Under this form, two amounts are used on the basis of their relation. One amount is used as numerator and the other one is as denominator, and then the proportion is determined. Example, to measure liquidity, current ratio is used. Its formula as follows. Current ratio is equal to current assets divided by current liabilities. Example, current assets are of rupees 3 lakh and current liabilities of rupees 2 lakh is equal to 3 lakh divided by 2 lakh. Therefore, current ratio is 1.5. It means current ratio is 1.5:1. It's explained that where against current assets of rupees 1.5, current liability is rupees 1. 2. In terms of percentage. In this form, also two variables are used on the basis of their relation. One amount is used as numerator, another one is denominator, and then percentage are determined. Example, net profit ratio, its formula is as follows. Net profit ratio is equal to net profit divided by sales into 100. Example, sales is of rupees 3 lakh and net profit is of rupees 60,000 is equal to 60,000 divided by 3 lakh into 100 is equal to 20%. Therefore, net profit ratio is 20%. It shows that rupees 20 profit is earned from the sales of rupees 100. 3. In terms of times. Like proportion, here also one amount is disclosed as numerator and another is disclosed as denominator. But here the interpretation of ratio is in terms of time. This term is used for special type of components of accounting. Example, stock turnover, its formula is as follows. Stock turnover is equal to cost of goods sold divided by average stock. Example, cost of goods sold is rupees 3 lakh and average stock is rupees 1 lakh is equal to 3 lakh divided by 1 lakh is equal to 3 times. Stock turnover is 3 times. It means the stock of business is converted 3 times into cost of goods sold. 4. In terms of fraction. To determine the proportion of one component against the other component. This form is used. Example, the share capital of business unit is rupees 5 lakh. Non-current assets of business are 2 divided by 5 of share capital. In these circumstances, non-current assets is equal to share capital into share of non-current assets in share capital is equal to 5 lakh into 2 divided by 5 is equal to rupees 2 lakh. 5. In terms of days or weeks or months. In accounting, through certain ratios, time period is determined. This time period is calculated in terms of days, weeks, and months. This ratio provides information about collection period and payment period. Example, the formula of collection period is as follows. Collection period is equal to debtors plus bills receivables divided by credit sales into 365. Example, debtors are of rupees 50,000, bills receivable rupees 23,000 and credit sales rupees 7,30,000 is equal to 50,000 plus 23,000 divided by 7,30,000 into 365 is equal to 73,000 divided by 7,30,000 into 365 is equal to 36.5 days means 37 days. The collection period is 37 days. It shows that The amount of every credit sales will be paid by debtors on 37th day from the date of sales. 6. Classification of ratios. The classification of ratios can be done into two categories. 1. Traditional classification. 2. Functional classification. 1. Traditional classification. The computation of accounting ratios is done on the basis of financial statements. In these statements, trading account, profit and loss account, and balance sheet are included. Now in the company form, income statement and balance sheet are prepared. 1. Ratios of trading account and profit and loss account. 2. Ratios of balance sheet. 3. Composite ratios are covered. From computation of ratios of trading account and profit and loss account, both numerator and denominator are formed trading account and profit and loss account. Example, net profit ratio, net profit and sales, both components are from trading account and profit and loss account. For computation of ratios of balance sheet, both numerator and denominator are from balance sheet. Example, debt equity ratio. Both components are of balance sheet. In case of third type, one component is from trading account or profit and loss account and second component is from the balance sheet. Example, fixed assets turnover. In this ratio, assets are from balance sheet and sales are from trading account. 2. Functional classification. To measure financial health or to acquire information about different aspects of accounting of business entity, ratio analysis is used. These aspects include 1. Profitability. 2. Liquidity. 3. Solvency. 4. Efficiency. These aspects measure performance of the business entity according to their name. This classification is known as functional classification. In this classification, profitability ratios, liquidity ratios, solvency ratios, and efficiency ratios are included. Each aspect is a result of specific performance. In practice, this classification is widely used. 7. Profitability ratios. The main objective of every business is to earn profit. The earning capacity of the company is known as profitability. There are different ratios to measure profitability. As per the syllabus, the following profitability ratios are to be studied. Generally, these ratios are calculated in terms of percentage. 1. Gross profit ratio. 2. Operating ratio. 3. Operating profit ratio. 4. Net profit ratio. 1. Gross profit ratio. Meaning, gross profit ratio discloses the relation between gross profit and total net sales. Gross profit ratio is an income-based ratio. Where gross profit is an income and its proportion to sales is also income is determined. This ratio indicates percentage of gross profit to sales. Sales means revenue from operation. Operating income means the income which is generated from the business in which company deals. Sales mean net sales, that is, sales less sales return. What is the total sale? Credit sales plus cash sales. What is gross profit? Gross profit means excess of sales over cost of goods sold. What is cost of goods sold? Cost of goods sold is determined as follows. Opening stock of raw material plus purchase of raw material plus purchase expense minus closing stock of raw material, closing of goods consumed plus wages plus factory expenses, cost of goods sold. Note 1. For determination of cost of goods sold, production expenses are considered. For manufacturing units, trading units do not have production expenses. Therefore, for trading units, cost of goods consumed is treated as cost of goods sold. 2. Instead of disclosure of opening stock and closing stock, how changes in stock are disclosed? 1. Change in stock is equal to opening stock greater than closing stock. Positive differences. Added to cost of goods sold or deducted from income. 2. Change in stock is equal to opening stock less than closing stock. Negative differences. Deducted from cost of goods sold or added to income. Note, negative amounts, that is figures, are shown in bracket. Gross profit is equal to total net sales minus cost of goods sold. Formula. Gross profit ratio is equal to gross profit divided by total net sales into 100. Objective. Gross profitability of the business can be measured through gross profit ratio. Trend. It is income-based ratio. Thus, Its increasing trend indicates enhancement in profitability. Illustration 1. Calculate gross profit ratio from the given information of ZCO Limited. Particulars 2016-2017. Sales 4,80,000, 6 lakh. Gross profit 1,20,000, 1,80,000. Gross profit ratio is equal to gross profit divided by net sales into 100 is equal to 1,20,000 divided by 4,80,000 into 100 is equal to 25% is equal to 1,80,000 divided by 6 lakh into 100 is equal to 30%. Interpretation 1. As compared to previous year, gross profit ratio is increased from 25% to 30%. It indicates growth in gross profitability. 2. Gross profit is equal to sales minus cost of goods sold. 2016, 25% is equal to 100% minus 75%. 2017, 30% is equal to 100% minus 70%. It can be said that as compared to the previous year, cost of goods sold is reduced in current year from 75% to 70%. Therefore, gross profit rate is increased. Illustration 2. From the given information of O business entity, calculate gross profit ratio. Particulars 2016-2017. Sales 8 lakh, 12 lakh. Gross profit 6 lakh, 10 lakh. Gross profit is not provided. Thus, gross profit is required to be calculated. Gross profit is equal to sales minus cost of goods sold. 2016, 2 lakh is equal to 8 lakh minus 6 lakh. 2017, 2 lakh is equal to 12 lakh minus 10 lakh. Gross profit ratio is equal to gross profit divided by total net sales into 100. 2016 is equal to 2 lakh divided by 8 lakh into 100 is equal to 25%. 2017 is equal to 2 lakh divided by 12 lakh into 100 is equal to 16. 2 divided by 3%. That is 16.66%. Illustration 3. Information of 2 years of Q company is as follows. Calculate gross profit ratio. Particulars 2016-2017. Sales 10 lakh 20,000, 15 lakh 50,000. Sales return 20,000, 50,000. Opening stock 1 lakh 40,000, 1 lakh 60,000. Purchase 6 lakh, 8 lakh. Purchase expenses 30,000, 40,000. Closing stock 1 lakh 60,000, 1 lakh 50,000. Answer. To calculate gross profit ratio, gross profit is to be ascertained by preparing income statement. Particulars 2016-2017. Net sales 10 lakh 20,000 less sales return 20,000, 10 lakh. Sales 15 lakh 50,000, sales return 50,000, 15 lakh. Less cost of goods consumed. Opening stock 1 lakh 40,000. Purchase 6 lakh. Purchase expenses 30,000. Cost of goods consumed. Opening stock 1 lakh 60,000. Purchase 8 lakh. Purchase expenses 40,000. Less closing stock 7 lakh 70,000. 1 lakh 60,000. 6 lakh 10,000. Closing stock 10 lakh. 1 lakh 50,000. 8 lakh 50,000. Gross profit 3 lakh 90,000. 6 lakh 50,000. Gross profit ratio is equal to gross profit divided by net sales into 100. In 2016 is equal to 3 lakh 90,000 divided by 10 lakh into 100 is equal to 39%. In 2017 is equal to 6 lakh 50,000 divided by 15 lakh into 100 is equal to 43.33%. 2. Operating ratio. Meaning, operating ratio discloses the relation of operating cost and sales. Operating ratio is cost, that is expense-based ratio. This ratio shows proportion of operating cost to sales. What is operating cost? Operating cost is equal to cost of goods sold plus operating expenses. What are the operating expenses? Operating expenses are those expenses which are incurred for operating activities of business, where office expenses, that is administrative expense, sales distribution expenses, employees' benefit expenses, depreciation, amount written off, etc. are included. Note: non-operating incomes like interest received, dividend received, and profit on sales of assets are not considered during the determination of operating cost. The interest paid and losses on sale of assets are also not considered. Interest expense is financial expense, not an operating expense. Loss on sale of asset is other expense, not operating expense. Formula: operating ratio is equal to cost of goods sold plus operating expenses divided by net sales into 100. Objective: this ratio explains the operating cost of business entity, the business in which the unit is engaged. Example: a company manufactures and sells textile would acquire information about production cost of textile. If production cost is more than predetermined cost, necessary efforts are made to control it. Trend: the decreasing trend of this ratio is favorable, which indicates increasing operating profitability. Illustration 4. From the following information, calculate operating ratio of E company. Cost of goods sold rupees 4,80,000. Operating expenses rupees 1,20,000. Financial expenses rupees 1 lakh and sales rupees 8 lakh. Answer: operating ratio is equal to cost of goods sold plus operating expenses divided by net sales into 100 is equal to 4,80,000 plus 1,20,000 divided by 8 lakh into 100 is equal to 75%. Illustration 5. From the given information of K and Company Limited, calculate operating ratios of 2 years. Particulars: 2016-2017. Sales 15 lakh, 20 lakh. Cost of goods sold 7,50,000, 9 lakh. Administrative expenses 1 lakh, 1,50,000. Sales expenses 2,50,000, 3 lakh. Depreciation 1 lakh, 1 lakh. Financial expenses 1 lakh, 1 lakh. Income of interest, dividend 2 lakh, 2 lakh. Other expenses, non-operating 50,000, 50,000. Answer: computation of operating expenses. Particulars: 2016-2017. Administrative expenses 1 lakh, 1,50,000. Sales expenses 2,50,000, 3 lakh. Depreciation 1 lakh, 1 lakh. Total 4,50,000, 5,50,000. Operating ratio is equal to cost of goods sold plus operating expenses divided by net sales into 100. In 2016 is equal to 7,50,000 plus 4,50,000 divided by 15 lakh into 100 is equal to 12 lakh divided by 15 lakh into 100 is equal to 80%. In 2017 is equal to 9 lakh plus 5,50,000 divided by 20 lakh into 100 is equal to 14,50,000 divided by 20 lakh into 100 is equal to 72.5%. As compared to the previous year, reduction in operating ratio, it discloses increase in profit. Illustration 6. From the following information of S Limited, calculate operating ratio. Net sales rupees 28 lakh. Cost of goods sold rupees 18 lakh. Salary rupees 1,20,000. Other administrative expenses rupees 1,80,000. Sales expenses rupees 1,50,000. Interest on loan rupees 1,25,000. Loss due to fire rupees 25,000. Interest income on investments rupees 1,80,000. Answer: operating ratio is equal to cost of goods sold plus operating expenses divided by net sales into 100. Operating expenses is equal to salary rupees 1,20,000. Other administrative expenses rupees 1,80,000. Salary expenses rupees 1,50,000. Total rupees 4,50,000 is equal to 18 lakh plus 4,50,000 divided by 28 lakh into 100 is equal to 22,50,000 divided by 28 lakh into 100 is equal to 80.36%. 3. Operating profit ratio. Meaning: this ratio discloses relationship between operating profit and sales. This is an income-based ratio. This ratio shows the proportion of operating profit to sales. What is the operating profit? Sales minus operating cost. Formula: operating profit ratio is equal to operating profit divided by net sales into 100. Objective: this ratio indicates that how much is profit earned by the unit from the business in which unit deals. To determine this ratio in alternative way, assume the sales as 100% and deduct operating ratio from it. The remaining percentage will be operating profit ratio. Trend: since this ratio is income based, the increasing trend of it indicates enhancement in profit. Illustration 7. From the following information calculate 1. Operating ratio and 2. Operating profit ratio. Particulars: sales 39 lakh, cost of goods consumed 25 lakh, sales expenses 75,000, loss due to accident 40,000, factory expenses including depreciation 50,000, wages 2 lakh, administrative expenses 1,75,000, interest on loan 60,000, dividend received on investments 1 lakh, tax rate 30%. Answer: cost of goods sold, cost of goods consumed is equal to rupees 25 lakh plus wages is equal to rupees 2 lakh, total rupees 27 lakh. Administrative expenses is equal to rupees 1,75,000 plus sales expenses is equal to rupees 75,000 plus factory expenses including depreciation is equal to rupees 50,000. Total operating expenses is equal to rupees 3 lakh. 1. Operating profit ratio is equal to cost of goods sold plus operating expenses divided by net sales into 100 is equal to 27 lakh plus 3 lakh divided by 39 lakh into 100 is equal to 30 lakh divided by 39 lakh into 100 is equal to 76.92%. Operating cost is equal to cost of goods sold plus operating expenses is equal to 27 lakh plus 3 lakh is equal to 30 lakh. Operating profit is equal to net sales minus operating cost is equal to 39 lakh minus 30 lakh is equal to 9 lakh. 2. Operating profit ratio is equal to operating profit divided by net sales into 100 is equal to 9 lakh divided by 39 lakh into 100 is equal to 23.08%. 4. Net profit ratio, meaning this ratio discloses the relationship between net profit and sales. This is an income-based ratio. This ratio shows the percentage of net profit to sales. What is net profit? The amount remaining after deducting all the expenses from the total income. This profit can be calculated as under. Particulars: sales less sales return, net sales at non-operating income, total income less cost of goods sold, operating expenses, financial expenses, non-operating expenses, profit before tax less income tax, profit after tax. Formula: net profit ratio is equal to net profit after tax divided by net sales into 100. Objective: the overall profitability of business can be seen through this ratio. All incomes and expenses are considered. Trend: since this ratio is income based, increasing trend of it indicates enhancement in total profitability, that is net profitability. 8. Liquidity ratios. The basic objective of every business is to earn profit. The credit worthiness provides fuel to the earning capacity of the business. The credit worthiness depends upon the financial solvency of the company. In accounting, the solvency is determined with two viewpoints. 1. Long-term solvency and 2. Short-term solvency. Short-term solvency is known as liquidity. Liquidity means the liability of business you need to pay short-term liabilities. Short-term liability means current liabilities. As per the syllabus, the following ratios are to be studied. Generally, these ratios are presented in terms of proportion. 1. Current ratio. 2. Liquid ratio. 1. Current ratio. Meaning, current ratio shows relation between current assets and current liabilities. What is the proportion of current liabilities against current assets is indicated by this ratio. It can be said that the liquidity position of business entity is good if the proportion of current assets is higher than current liabilities. More liquidity means more short-term solvency. Formula: current ratio is equal to current assets divided by current liabilities. Current assets means which is in the cash form or cash equivalent, or which can be converted into cash within 12 months, or which can be converted into cash equivalent. The following can be included in it: current investments, stock, that is excluding loose tools, trade receivables, that is bills receivable and debtors after deduction of bad debt reserve, cash and cash equivalent, that is cash on hand, bank balance, check or draft on hand, short-term lending, and advances paid in advance, income, outstanding taxes paid in advance, etc. Current liability means such liabilities which are payable within the time period of 12 months. Short-term borrowings, trade payables, that is bill payable, and creditors, interest payable on long-term liabilities, due but not pay liability, due but not pay interest, expenses outstanding, uncalled dividend, installments received in advance, short-term provisions are included in current liabilities. Objective: the objective of this ratio is to know the capacity of business unit to pay short-term obligation. Trend: the proportion of this ratio varies industry to industry. Generally, 2:1 proportion of this ratio is considered to be an ideal. If this ratio is greater than the standard, it indicates the loss of interest, and the lower ratio than the standard creates interruption in manufacturing process. Thus, its standard proportion is desirable. The difference of current assets and current liabilities is known as working capital. Working capital also used for the measurement of liquidity. In brief, current assets divided by current liabilities is equal to current ratio. In proportion, current assets minus current liabilities is equal to working capital in rupees. Illustration 8. From the following information of M Limited, calculate current ratio. Current assets rupees 1,50,000, working capital rupees 60,000. Answer: current ratio is equal to current assets divided by current liabilities. Current assets are of rupees 1,50,000. Current liabilities are not given, but working capital is given. Working capital is equal to current assets minus current liabilities. Rupees 60,000 is equal to rupees 1,50,000 minus current liabilities. Therefore, current liabilities is equal to current assets minus working capital. Therefore, current liabilities is equal to rupees 1,50,000 minus rupees 60,000. Therefore, current liabilities is equal to rupees 90,000. 1,50,000 divided by 90,000 is equal to 1.67:1. 2. Liquid ratio. Meaning, liquid ratio shows relation between liquid assets and current liabilities. This ratio indicates the proportion of liquid assets against current liabilities. This ratio also discloses the liquidity of the business entity. From the current assets, the stock and expenses paid in advance are deducted. The balancing figure is liquid assets. Note: here current assets excluding stock and expenses paid in advance are considered to determine liquid assets. Formula: liquid ratio is equal to liquid assets divided by current liabilities. Liquid assets are such assets which are easily convertible in cash and cash equivalent. Current liabilities, which are considered for current ratio, are also considered for this ratio. Objective: the objective of this ratio is also to measure liquidity. The purpose is to measure capacity to pay short-term liabilities. This ratio indicates better capacity in paying short-term liabilities than the current ratio. This ratio is also known as quick ratio. There is no time period of 12 months prescribed for the conversion of assets into cash. Thus, this ratio is faster than current ratio to pay short-term liabilities. Trend: generally, the proportion of this ratio 1:1 is desirable. Illustration 9. From the following information of SL Limited, calculate liquid ratio. Particulars: rupees. Particulars: rupees. Current liabilities: 1,60,000. Stock: 30,000. Debtors: 20,000. Current assets: 2 lakh. Expenses paid in advance: 10,000. Bills receivables: 15,000. Answer: liquid ratio is equal to liquid assets divided by current liabilities. Liquid assets, current assets: 20,000 less stock: 30,000. Expenses paid in advance: 10,000. 40,000. 1,60,000 is equal to 1,60,000 divided by 1,60,000 is equal to 1:1. Illustration 10. From the following information of I Limited, calculate current ratio and liquid ratio. Particulars, rupees. Particulars, rupees. Cash and cash equivalent 1,80,000. Debtors 1,20,000. Bills receivables 60,000. Stock 1,40,000. Current investments 1 lakh. Creditors 20 lakh. Bills payables 1 lakh. Outstanding expenses 80,000. Taxation provision 80,000. Answer. Current ratio. Current assets divided by current liabilities. Current assets. Cash 1,80,000. Debtors 1,20,000. Bills receivables 60,000. Current investments 1 lakh. Stock 1,40,000. Total 6 lakh. Current liabilities. Creditors 2 lakh. Bills payables 1 lakh. Outstanding expenses 80,000. Taxation provision 80,000. Total 4,60,000 is equal to 6 lakh divided by 4,60,000 is equal to 1.30:1. Liquid ratio is equal to liquid assets divided by current liabilities. Liquid assets current 6 lakh less stock 1,40,000 is equal to 4,60,000 is equal to 4,60,000 divided by 4,60,000 is equal to 1:1. Relation of current assets and current liabilities with current ratio. The current ratio emerges from two variables, 1. Current assets and 2. Current liabilities. Thus, there is an influence of change in current assets and current liabilities on current ratio. This influence is as follows. Increase in current assets, increase in current ratio. Decrease in current assets, decrease in current ratio. This relation shows that there is a direct relation between the current assets and the current ratio. Increase in current liabilities, decrease in current ratio. Decrease in current liabilities, increase in current ratio. This relation shows that there is an inverse relation between the current liabilities and the current ratio. Note, the relation between the liquid assets and the current liabilities with liquid ratio is also the same. Increase in liquid assets, increase in liquid ratio. Decrease in liquid assets, decrease in liquid ratio, and increase in current liabilities, decrease in liquid ratio. Decrease in current liabilities, increase in liquid ratio. Solvency ratios. Generally, economic or financial solvency is considered in the context of long term. Solvency is used to measure economic health to business entity. This ratio is used to measure how far the business entity is competent enough to pay long-term liabilities. This ratio is computed for economic aspects. These ratios are disclosed in terms of proportion. 1. Debt to equity ratio. 2. Total assets to debt ratio. 3. Proprietary ratio. 4. Interest coverage ratio. 1. Debt to equity ratio. Meaning, debt to equity ratio shows relation between debt and equity, that is, shareholders' funds. This ratio indicates the proportion of equity against debt. Here, equity means shareholders' funds. Equity share capital and reserves and surplus are included in shareholders' fund. A business entity is considered as less solvent when the proportion of equity is greater than debt. Business entity is considered as less solvent when the proportion of the equity is less than the debt. Formula: debt, that is non-term liabilities, divided by equity, that is shareholders' funds. The equity and liabilities side of balance sheet shows three divisions. 1. Shareholders' funds. 2. Non-current liabilities. 3. Current liabilities. Shareholders' funds and non-current liabilities are the long-term sources of funds of a business entity. That remains for long-term in business. These are not procured every year. But shareholders' funds are owners' funds and non-current liabilities are the liabilities towards external parties. Both are long-term sources of finance but are different from ownership viewpoint. Here, liability means long-term liabilities, where 1. Long-term borrowings, 2. Deferred tax liability, 3. Other long-term liability, and 4. Long-term provisions are included. Shareholders' funds is equal to equity share capital plus preference share capital plus reserves and surplus. If debit balance of profit and loss account is appeared in the balance sheet, it will be deducted for the determination of shareholders' funds. Then the arrived amount of shareholders' funds will be used to compute this ratio. Preference share capital is included in shareholders' funds. Objectives. The objective of this ratio is to know the proportion of owner's capital, that is, shareholders' funds, and borrowed funds, that is, non-current liabilities, which are acquired by the business as long-term sources of finance. Trend. There is no standard measure for this ratio. This varies industry to industry. If this ratio is higher, it indicates that the business unit is more on the borrowed funds, and if this ratio is lower, it indicates that the business unit is less dependent on the borrowed capital. If this ratio is reported high, it is risky for the lenders, and if it is reported low, it is less risky for the lenders to lend their funds. Balance sheet. Equity and liabilities. Companies X, Y, Z. A. Shareholders fund 25%, 37.5%, 50%. B. Non-current liabilities 50%, 37.5%, 25%. C. Current liabilities 25%, 25%, 25%. Total 100%, 100%, 100%. Assets. Companies X, Y, Z. A. Non-current assets 100%, 100%, 100%. B. Current assets. Total 100%, 100%, 100%. Total asset debt ratio is equal to total asset divided by debt, that is, long-term liabilities. 1. In case of X company, the proportion debt is higher against shareholders' funds. Thus, it is less solvent than Y and Z. 2. Y company has less debt than that of X. Thus, it is more solvent against X company, but less solvent against Z company. 3. Z has the lowest debts against all companies. Thus, it is more solvent. X 50 divided by 25, 2:1. Y 37.5 divided by 37.5, 1:1. Z 25 divided by 50, 0.50:1. Illustration 11. From the following information of FL Limited, calculate debt equity ratio. Particulars rupees. Particulars rupees. Equity share capital 10 lakh. General reserve 6 lakh. Profit and loss account 4 lakh. Outstanding expenses 1 lakh. Long-term loan 2 lakh. Long-term provisions 2 lakh. Answer. Debt to equity ratio is equal to liabilities, that is long-term liabilities, divided by equity, that is shareholders' funds. Liabilities, non-current liabilities, long-term loan 2 lakh, long-term provisions 2 lakh, total 4 lakh. Equity, shareholders' fund, equity share capital 10 lakh, general reserve 6 lakh, profit and loss account 4 lakh, total 20 lakh. 4 lakh divided by 20 lakh is equal to 0.20:1. Against owner's funds of rupees 1 of the business entity, non-current liability is rupees 0.20. Note, outstanding expenses and current liability will not be included in debt equity. Only non-current liabilities will be considered. 2. Total assets to debt ratio. Meaning, total assets to debt ratio shows relation between total assets and debt, that is non-current liabilities. Out of total assets, the proportion of assets acquired by debt can be ascertained from this ratio. Formula: total assets to debt ratio is equal to total assets divided by debt, that is long-term liabilities. To determine total assets, other non-current assets are not to be considered. Example: trade receivables of more than 12 months, expenses not written off, etc. To determine debt, non-current liabilities are to be considered, but other long-term liabilities are not to be considered. Example: payables of more than 12 months, debenture redemption premium when debentures are disclosed under the head of long-term liabilities. Objectives: it can be ascertained that out of total assets, what proportion of total assets is acquired through non-current liabilities. Trend: there is no standard measure for this ratio. This ratio indicates reserve trend to trend of debt equity ratio. Generally, when this ratio is higher, it is less risky to the lenders to lend their funds, and if it is lower, it is more risky to lend funds. Balance sheet. Equity and liabilities. Companies X, Y, Z. A. Shareholders funds 25%, 37.5%, 50%. B. Liabilities. Non-current liabilities 50%, 37.5%, 25%. C. Current liabilities 25%, 25%, 25%. Total 100%, 100%, 100%. Assets. Companies X, Y, Z. Non-current assets and current assets 100%, 100%, 100%. Total 100%, 100%, 100%. 1. X company has acquired 50% assets from debt. X company is less solvent as compared to Y and Z company. 2. Y company has less debt, thus it is more solvent as compared to X company. 3. The quantum of debt is lowest in case of Z company, thus it is the most solvent. X 100 divided by 50, 2:1. Y 100 divided by 37.5, 2.67 is to 1. Z 100 divided by 25, 4:1. Illustration 12. From the following information of DB Co Limited, calculate total assets to debt ratio. Rupees non-current assets, that is gross, 28 lakh. Accumulated depreciation on fixed assets, 3 lakh. Current assets, 5 lakh. Equity share capital, 18 lakh. Reserves and surplus, 5 lakh. Total liabilities, 7 lakh. Current liabilities, 1 lakh. Answer. Total assets to debt ratio is equal to total assets divided by debt, that is long-term liabilities. Total assets is equal to rupees non-current assets, that is gross, 28 lakh, less depreciation, 3 lakh. 25 lakh add current assets, 5 lakh, total 30 lakh. Debt is equal to rupees total liabilities, 7 lakh, less current liabilities, 1 lakh, total 6 lakh. Total assets minus debt ratio is equal to 30 lakh divided by 6 lakh is equal to 5:1. 3. Proprietary ratio, meaning proprietary ratio shows relation between the total assets and the owner's fund, that is shareholders' funds. There are two approaches used to determine the owner's funds. Under both the approaches, owner's funds remain identical. Approaches of owner's funds. Liabilities-based approach owner's funds is equal to equity share capital plus preference share capital plus reserve and surplus. Assets-based approach owner's funds is equal to non-current assets plus current assets less non-current liabilities plus current liabilities. Formula. Proprietary ratio is equal to owner's fund divided by total assets. Objective. This ratio shows what proportion of total assets is acquired by owner's funds. It is further assumed that remaining assets are acquired by borrowed funds. Trend. This ratio provides information of economic solvency and margin of safety to the creditors of business. The higher the ratio, higher the economic margin of safety, and the lower the ratio, the lower the economic margin of safety. Illustration 13. From the following information of M Limited, calculate proprietary ratio. Balance sheet as on 31st March 2017. Particulars. Amount. Number 1. Equity and liabilities. 1. Shareholders funds. Equity share capital, 20 lakh. Preference share capital, 10 lakh. Reserve and surplus, 15 lakh. 45 lakh. 2. Non-current liabilities, 15 lakh. 3. Current liabilities, 10 lakh. Total, 70 lakh. Number 2. Assets. 1. Non-current assets, 50 lakh. 2. Current assets, 20 lakh. Total, 70 lakh. Answer. Proprietary ratio is equal to proprietor's fund, that is owner's funds, divided by total assets. To determine total assets, either liability-based approach or assets-based approach can be used. Liabilities-based approach, amount. Assets-based approach, amount. Equity share capital, 20 lakh. Preference share capital, 10 lakh. Reserves and surplus, 15 lakh. Total, 45 lakh. Non-current assets, 50 lakh. Plus current assets, 20 lakh. 70 lakh. Less non-current liabilities, 15 lakh. Current liabilities, 10 lakh. 25 lakh. Total, 45 lakh. Proprietary ratio is equal to proprietor's fund divided by total assets is equal to 45 lakh divided by 70 lakh is equal to 0.64:1. Rupees 1 assets minus rupees 0.64 assets from owner's fund. Total rupees 0.36 assets from borrowed funds. Out of assets of rupees 1, assets of rupees 0.64 are acquired through owner's funds and remaining assets of rupees 0.36 are obtained through borrowed funds. 4. Interest coverage ratio, meaning this ratio shows the relation between the earning before interest and tax and the interest on the long-term debt. This ratio shows earning capacity. Thus, if calculated in terms of times, formula: interest coverage ratio is equal to earning before interest and tax divided by interest on long-term debt. Earning before interest tax is equal to earnings after tax plus interest. Objectives: there are two ways to provide capital to the business: capital provided by the owners and capital borrowed from the external parties. No interest is paid on the owner's capital, but the interest is paid on the borrowed capital. Before lending funds to the business, lenders examine the interest payment capacity of the business enterprise. To examine status of interest payment capacity, this ratio is used. Trend: this ratio indicates the interest payment capacity of the business. Thus, higher the ratio, higher the interest payment capacity of the business and vice versa. Illustration 14. From the following information of K Company Limited, calculate interest coverage ratio. Particulars: profit after tax rupees 7,50,000, 10% debentures 20 lakh, tax paid 2,50,000, 12% loan 10 lakh. Answer: interest on long-term liabilities. Interest on 10% debentures of rupees 20 lakh is equal to rupees 2 lakh plus interest on 12% loan of rupees 10 lakh is equal to rupees 1,20,000. Therefore, total interest on long-term liabilities is equal to rupees 3,20,000. Profit before interest and tax, profit after tax is equal to rupees 7,50,000 plus taxes is equal to rupees 2,50,000 plus interest on long-term liabilities is equal to rupees 3,20,000. Therefore, profit before interest and taxes is equal to rupees 13,20,000. Interest coverage ratio is equal to profit before interest and tax divided by interest on loan and term liabilities is equal to 13,20,000 divided by 3,20,000 is equal to 4.125 times. Therefore, interest coverage ratio is equal to 4.125 times. 10. Efficiency, that is activity ratios. The profitability of the business increases when all resources and equipments acquired by the business entity are used effectively. In this context, efficiency or activity ratios are developed. These ratios are calculated in terms of times. Another ratio in this category is debtors turnover and creditors turnover. From these two ratios, debtors collection period and creditors payment periods are determined. This period may be in terms of days, weeks, or months. 1. Stock turnover. 2. Working capital turnover. 3. Debtors turnover. 4. Creditors turnover. 1. Stock turnover ratio, meaning this ratio shows relation between the cost of goods sold and average stock. How many times stock is converted into production and sales can be ascertained by this ratio. Formula: stock turnover is equal to cost of goods sold divided by average stock. How to determine cost of goods sold is already studied under the gross profit ratio determination. It is again represented as follows: cost of goods sold, opening stock of raw material plus purchase of raw material plus purchase expenses minus closing stock of raw material, cost of goods consumed plus wages plus factory expenses. Cost of goods sold. Cost of goods sold can be determined also as follows: gross profit is equal to sales minus cost of goods sold. This formula can be modified as follows: cost of goods sold is equal to sales minus gross profit. In case of gross loss, cost of goods sold is equal to sales plus gross loss. Average stock is equal to opening stock plus closing stock divided by 2. Objective. This ratio is the measurement of efficiency for the conversion of stock into sales. Trend. Generally, the increasing trend is acceptable. The increasing trend shows that very often the stock is converted into cost of goods sold and finally into sales. Generally, it is established that higher the ratio, higher the sales, higher the profit. Theoretically, higher ratio can be a result of deficit, that is, shortage of working capital, and lower ratio can be the result of unnecessary investment in working capital. Thus, it is desirable to maintain optimum level of stock. Illustration 15. From the following information of DD Company Limited, calculate stock turnover ratio. Particulars rupees. Particulars rupees. Opening stock 30,000. Purchase 4,80,000. Closing stock 40,000. Purchase expenses 20,000. Answer. Stock turnover is equal to cost of goods sold divided by average stock. Cost of goods sold is equal to rupees. Opening stock 30,000 plus purchase 4,80,000 plus purchase expenses 20,000. 5,30,000 minus closing stock 40,000, 4,90,000. Average stock is equal to opening stock plus closing stock divided by 2 is equal to 30,000 plus 40,000 divided by 2 is equal to rupees 35,000. Stock turnover is equal to 4,90,000 divided by 35,000 is equal to 14 times. 2. Working capital turnover ratio, meaning this ratio shows the relation between sales and working capital. If sales are not available, the relation between the cost of goods sold and the working capital is examined. From this ratio, it is ascertained that how many times the working capital generates sales. Formula: working capital turnover is equal to sales or cost of goods sold divided by working capital. When sales are not given in the question, the ratio is to be calculated on the basis of cost of goods sold. Objective: the purpose to invest in working capital is to yield revenue. This ratio is used to examine the efficiency of working capital. As compared to stock turnover ratio, this ratio gives better results for efficiency measurement. In stock turnover, only stock is considered, but for this ratio, working capital is considered. Trend. Generally, the increasing trend is favorable. Theoretically, the increasing trend shows the effective use of working capital, which is the cause of higher sales and consequently of higher profit. Illustration 16. From the following information of HR Limited, calculate working capital turnover. Total sales rupees 22,20,000. Current assets rupees 6 lakh. Sales return rupees 20,000. Current liabilities rupees 2 lakh. Answer: working capital turnover is equal to sales divided by working capital. Sales rupees. Total sales 22,20,000 less sales return 20,000. Total 22 lakh. Working capital. Capital assets 6 lakh less current liabilities 2 lakh. Total 4 lakh is equal to 22 lakh divided by 4 lakh is equal to 5.5 times. Illustration 17. From the following information of ML Limited, calculate working capital turnover. Working capital rupees 3 lakh. Cost of goods sold rupees 15 lakh. Gross profit rate 25%. Answer: working capital turnover is equal to sales divided by working capital. Sales, cost of goods sold plus gross profit. Assume sales 100 is equal to 75% plus 25%. 20 lakh is equal to 15 lakh plus 5 lakh is equal to 20 lakh divided by 3 lakh is equal to 6.67 times. On the basis of cost of goods sold is equal to 15 lakh divided by 3 lakh is equal to 5 times. 3. Debtors turnover ratio, meaning this ratio is known as receivable turnover ratio also. From this ratio, it can be ascertained that how many times debtors and receivables emerge from credit sales. This ratio shows relation between credit sales and trade receivables. Formula: debtors turnover is equal to credit sales divided by average trade receivables. Trade receivables mean average of debtors and bills receivables of credit sales. Average trade receivables is equal to opening trade receivables plus closing trade receivables divided by 2. Note, during determination of trade receivables, bad debt reserve should not be deducted from the debtors. This ratio is for collection period, not for receivable amount. Objectives. From this ratio, it can be ascertained that how many times debtors and bills receivables are emerged due to credit sales. This turnover shows that how quickly the collection is converted into cash or cash equivalent. Trend. This is performance measurement ratio. Higher ratio shows higher collection efficiency and lower investment in debtors and bills receivable, while lower ratio shows lower collection efficiency and high investment in debtors and bills receivables. The collection period is determined from this ratio. As stated above, the high turnover of debtors gives quick collection and the lower turnover of debtors gives slow collection. This time period can be in terms of days, weeks and months. Formulas pertaining to this are as follows. Collection period in months is equal to 12 divided by debtors turnover. Collection period in weeks is equal to 52 divided by debtors turnover. Collection period in days is equal to 365 divided by debtors turnover. Note, to compute this ratio, clear instruction should be given to the students. Example, 12 months, 52 weeks or 365 days. Illustration 18. From the following information of RR Limited, determine debtors turnover and collection period in months, weeks and days. Particulars, rupees. Particulars, rupees. Total sales, 40 lakh. Opening debtors and bills receivables, 4 lakh. Cash sales, 3,50,000. Closing debtors and bills receivables, 3,30,000. Answer. This kind of problems is solved in 2 stages, which are as follows. A. Debtors turnover is equal to credit sales divided by average trade receivables. Credit sales, total sales 40 lakh minus cash sales 3,50,000. Total 36,50,000. Average trade receivables is equal to opening debtors and bills receivables plus closing debtors and bills receivables divided by 2 is equal to 4 lakh plus 3,30,000 divided by 2 is equal to rupees 3,65,000. 36,50,000 divided by 3,65,000 is equal to 10 times. B. Collection period. In months, A. 12 divided by debtors turnover, 12 divided by 10, 1.2 months. In weeks, B. 52 divided by debtors turnover, 52 divided by 10, 5.2 weeks. In days, C. 365 divided by debtors turnover, 365 divided by 10, 36.5 days, that is 37 days. 4. Creditors turnover ratio, meaning this ratio is known as payable turnover ratio also. From this ratio, it can be ascertained that how many times creditors and bills payables are emerged by credit purchase. This ratio shows the relation between the credit purchase and trade payables. Formula: creditors turnover is equal to credit purchase divided by average trade payables. Average trade payables mean average of creditors and bills payable of credit purchase. Average trade payables is equal to opening trade payables plus closing trade payables divided by 2. Objectives: from this ratio, it can be ascertained that how many times creditors and bills payables are emerged due to credit purchase. This ratio indicates how quickly the payment is made. Trend: this is a performance measurement ratio. Lower ratio shows higher payment efficiency. Owner has to spare his own capital in low quantum due to creditors and bills payables. Higher ratio shows lower payment efficiency. The payment period is determined from this ratio. This time period can be in months, weeks and days. Formula in this context, similar to collection period, are as follows. The payment period in months is equal to 12 divided by creditors turnover. The payment period in weeks is equal to 52 divided by creditors turnover. The payment period in days is equal to 365 divided by creditors turnover. Illustration 19. From the following information of C Company Limited, Calculate creditors' turnover and payment period in days. Assume 360 days of the year. Particulars: amount. Opening balances: creditors 45,000, bills payables 15,000, bills receivables 30,000, debtors 30,000. Closing balances: creditors 40,000, bills payables 20,000, bills receivables 40,000, debtors 20,000. Credit sales 6 lakh, cash sales 4 lakh, total sales 10 lakh, total purchase 6 lakh, cash purchase 2 lakh 40,000. Answer: credit purchase is equal to total purchase minus cash purchase is equal to rupees 6 lakh minus rupees 2 lakh 40,000 is equal to rupees 3 lakh 60,000. Average trade payables is equal to opening creditors and bills payables plus closing creditors and bills payables divided by 2 is equal to rupees 45 lakh plus rupees 15 lakh plus rupees 40 lakh plus rupees 20 lakh divided by 2 is equal to rupees 60,000. Creditors turnover is equal to credit purchases divided by average trade payables is equal to 3,60,000 divided by 60,000 is equal to 6 times. Payment period 1 in day is equal to 360 divided by credits turnover is equal to 360 divided by 6 is equal to 60 days. 2 in weeks is equal to 52 divided by credits turnover is equal to 52 divided by 6 is equal to 8.67 weeks. 3 in months is equal to 12 divided by credits turnover is equal to 12 divided by 6 is equal to 2 months. Creditors turnover is equal to 6 times. Payment period 1 60 days, 2 8.67 weeks, 3 2 months. Illustration 20. From the following information of AA Company Limited, calculate creditors turnover and payment period in days. Particulars: rupees. Particulars: rupees. Total purchase 35 lakh. Purchase return 2 lakh. Closing trade payables 4 lakh 60,000. Cash purchase 3 lakh. Opening trade payables 5 lakh 40,000. Answer: A. Creditors turnover is equal to credit purchase divided by average trade payables. Credit purchase: total purchase 35 lakh minus purchase return 2 lakh, total 33 lakh minus cash purchase 3 lakh, total 30 lakh. Average trade payables is equal to opening trade payables plus closing trade payables divided by 2 is equal to 5 lakh 40,000 plus 4 lakh 60,000 divided by 2 is equal to 5 lakh. So 30 lakh divided by 5 lakh is equal to 6 times. B. Payment period in days is equal to 365 divided by creditors turnover is equal to 365 divided by 6 is equal to 60.83 is equal to 61 days.